banks and bureaus to change under the following framework. A. Denominating the existing RTGS balances, bond notes, and coins in circulation as RTGS dollars, in order to establish an exchange rate between the current monetary balances and foreign exchange. The RTGS dollars thus become part of the multi-currency system in Zimbabwe. The legal instrument to give effect to this has been prepared and shall be gazetted soon. B. The RTGS dollars shall be used by all entities in Zimbabwe, including government and individuals in Zimbabwe, for the purposes of pricing of goods and services, recorded debts, accounting, and settlement of domestic transactions. C. The use of RTGS dollars for domestic transactions will eliminate the existence of the multi-tier pricing system and charging of goods and services in foreign currency within the domestic market. In this regard, prices in Zimbabwe should remain at their current levels and or to start to decline in sympathy with the stability in the foreign exchange rate, given the current monetary balances have not changed. In this respect, the Reserve Bank will commit all its efforts to use the instruments at its disposal to maintain stability of the exchange rate. The bank has arranged sufficient lines of credit to enable it to maintain adequate foreign currency to underpin the foreign exchange market. This is essential to restore the purchasing power of RTGS balances through safeguarding price stability emanating from the pass-through effects of the exchange rate movements. E. Foreign currency for the interbank market shall be utilized for current bona fide payments for current invoices, except for educational fees. F. All foreign liabilities or legacy debts due to suppliers and service providers such as IATA, declared dividends, portfolio investment, and others shall be treated separately after registering such transactions with exchange control for the purposes of providing the bank with sufficient information that will allow it to determine the roadmap for orderly expansion of the legacy debt. Foreign currency requirements for government expenditure and other essential commodities that include fuel, cooking oil, electricity, medicines, and other chemicals shall continue to be made available through the existing letters of credit facilities and or the Foreign Allocations Committee. Banks shall report activities of the interbank foreign currency market to the bank that shall closely monitor the foreign currency trades on a daily basis using the form and format stipulated by the bank. For the first 2 weeks, the Reserve Bank shall monitor the banks on a 2-hour basis. Bearers of change shall be authorized to purchase foreign currency without limits, but shall be limited to sell foreign currency for small transactions such as subscriptions, business and personal travel, up to a maximum aggregate daily limit of 10,000 per bearer to change. Like with the banks, bearers to change and their agents shall report their activities of their interbank on a daily basis as required by the bank. In order to allow exporters to benefit from the interbank foreign currency market and promote uninterrupted supply of foreign currency to the economy, the export retention schemes or thresholds measuring shall retain 80% of the export process. Gold producers, large-scale producers, 55% is the current position. Small-scale gold producers retain 55%. All other minerals, 50%. 50%. Tobacco and tobacco merchants who are in the input schemes, 80%. Tobacco and cotton growers shall retain 30%. Horticulture, 80%. Transport, 80%. So is tourism, 80%. Similarly, in order to enhance liquidity within the foreign currency market, exporters shall be entitled to utilize their retained export receipts within 30 days, after which their utilized export receipts will be offloaded into the market at the policy number. Local settlement of Nostro FC tranches. Given the successful completion of the separation of RTGS and Nostro FC accounts, the bank is, from the 25th of February, putting in place a local Nostro FCA settlement platform to allow for domestic inter-bank settlement of Nostro FCA transfers. Operational targets for money to put in place robust anti-money laundering and counter-financing of terrorism for businesses and professionals and its card infrastructure.
Thank you. Can we have questions from the floor?
Move in the direction of a more market-based approach, but I think Thank you. Certainly, the movement from control of exchange rates going into the auction system is positive. My question to the Central Bank Governor is that, is there any indication of the rate or the target which you are working toward? The second point is that we all know that monetary policies need to be supported by fiscal policy measures. It would be useful if the Treasury we hear some comments on the fiscal side that complement the monetary policy. Thank you.
Thank you. We'll take another question. Two more questions.
Thank you. My name is Kai Chore from Parliament. I wanted to ask the governor the implication of this market.
Governor, if this monetary statement marks the migration from the multi-currency system into adopting a wholly Zimbabwean local currency, because the auction system, to me, it sounds like we have a currency now in place which is tradable.
Thank you. May I ask the governor to respond to these questions, and then we will take some more. Thank you.
Thank you very much for the questions, which I do believe are very rich questions. Professor, thank you, and definitely we will safeguards to ensure that at least, as you said in my first statement, to ensure that there is price stability and the exchange stability. The role of the central bank, if you have noticed, we are saying that the central bank want to move to shift to our key result areas of doing two things basically: price stability and exchange rate stability. By ensuring that there is a stable exchange rate in Zimbabwe, that the inflation is low, it means, what are we doing? It means we are basically preserving value for money. We are securing the purchasing power parity for money, as opposed to let the power exchange markets determine the value for money. What the other hand, the money is being eaten, so to say, by inflation, which is caused by the pass-through effects of the power exchange rates. Therefore, the best way to restore value for money the best way to ensure that the money we purchase in Paris or the purchase for money is restored is to ensure that we manage inflation, manage stability of the exchange rate. If the rate goes down from 4 or 3.5 to 3 to 2.5, for example, you know that we are reserving value for money. The question that is, how do you do it? It's where the question which my brother Anthony asked, movement in the rate is the target. Right now we are so encouraged by the fact that the fiscal side of the equation is not producing the RTG's balances as before. And also because of the tax measures that have been put in place, we have seen money moving from consumers, government, money moving from consumers to the business. That constraint tells us that already there is the money supply is gone down. Inflation is caused by increased money supply. Right now, the increased money supply is lower than before, which means that people, if they have not too much money to chase too few foreign currency or goods in the market. In our target for the rate, we don't have a target there because we are saying it's a willing buyer, willing seller, which comes to what someone says. How do you control the runaway inflation? We manage the runaway inflation from two ways. One, to ensure that, as we have said in my statement here, we've put in place lines of credit to stabilize the stability of the exchange rate. Two, we are ensuring that the interbank will provide foreign currency to those bona fide transactions, not for the purposes of funding nostro accounts. That's not a bona fide transaction. Someone goes to the bank with a current invoice, which is by a foreign currency, and will purchase the money from the bank and conduct the business. And also manage the runaway of dollars, of the rate, from the perspective that people really have the money. To give you statistics for this economy, out of 3.8 million accounts, you'll find that people with the money above 1,000 accounts, they are only about 10%. So it's very simple for us to see those ones who by manipulating the rate of exchange. We cannot manipulate not through the ESA, but through the banking sector. That's why we said we want to monitor the banking sector to see who will be that one with too much money. That's why I spend more time on the anti-money laundering measures. That's why I spend more of my time on compliance for banks to ensure that we do monitor those who have too much money in what are they doing with it, what are they importing. So ours is more of monitoring compliance in terms of the laws of Zimbabwe. So we don't expect to see the runaway of the exchange rate. If the rate is right now is between 3 and 4 or just 3.5, an average target, we expect to go down for the measures that we put in place. And we expect that pass through or that benefit to go to the consumers. For most of the governments we're now using the power markets for pricing purposes. And the limiting factors as follows. If firms continue to increase their prices, they are going to find no sale. There will be no sale. That will be a good problem. Because of their choice. there is a limit to which the price can continue to go up. And those are the fundamentals in the market. And as we start with to be going down to safeguard and to assist the market, also know that the producers of exportable products are also going to increase. The missing link in this country is and was the right price of product. When we used to give an export incentive scheme, which by the way, after this falls away, naturally, was 5% or 10% export incentive now makes no sense when inflation is now 42.09%. The export incentive scheme was very useful when the inflation was below 5%. Because producers used to get the real incentive. Now before 2.5% or 42.09%, and with power markets at 3 to 4%, it means that that incentive is not overtaken by events. So the events of between October to date have significantly changed the landscape of this economy. Section 44B is being changed according to recognize the other TGS dollars in this economy, which is made up of quantities, balances, bond notes, and bond coins. You spoke about migration. We said that the other TGS dollars are going to be part of the basket of currencies in Zimbabwe. We've got the yuan, the US dollar, the rand, the Canadian dollar, we have got Botswana pula, Indian rupee. We are saying aside those ones, there will be other TGS dollars which are on the platform called other TGS platform. So I don't think we're migrating. We are only calling what it is today. If you ask me what we've done, we've basically formalized what is happening. We've basically ensured that no one goes and buy currency from the market, but there's a law there. It says 10 years prison. So we've provided if. But if you now want to buy foreign currency, it's no account. You go to the bank. If the bank is 1-to-1, then you can still get your 1-to-1 note from the US dollar $1,000. Or the other $100. And if the rate is now 2, for example, it means that you get 500. But your account remains just like your budget. It's in other $10. Just like all the money, we say that the banks, see, we were something called electronic dollars in Zimbabwe, which you all know. So that's the position. So migration, we are all calling by the names of what's happening. We don't migrate anything. We are only separating that these are $dollars, these are US dollars, and that they should talk to each other, which means exchangeability. That's what we've done. Thank you very much.
Thank you, Governor. We'll take more questions. Thank you. I'll ask you to go to that gentleman, then I'll come to you and to the lady. Okay, thank you.
Thank you very much. Question to the governor. I think I understood what he said.
Sorry, do you want to tell us who you are and where you are from?
Thank you. My name is Napoleon Nani. I'm from the Ginger Apple Group.
From?
Ginger Apple.
Ginger Apple.
Yes. My question is to the governor. If it's not, then what is it?
Can I take the question? Okay, Madam.
Hi, Gabrielle Steinmetz from the Wall Street Journal. There have been a lot of complaints about the Zimbabwe's economy, about businesses, about dollar allocations, that hasn't been done in a fair way, and that people were profiting from getting unfair that some businesses were getting unfair allocations of forex while others were getting their fair share. Do you expect this measure to resolve this problem, and that basically anybody who needs forex to import things will be able to get the forex that they need?
Thank you.
Looking at the statistics that were presented by the government, you will
Can
find,
you up your voice a bit?
yes, looking at the monetary statistics, you would find that foreign currency in circulation at around 451 million compared to money supply and RTGS balances. This inordinate imbalance would dictate that a temporal shock is unavoidable. One would naturally expect a soft landing strategy on part of Reserve Bank. What do we have to avoid a hard landing on the currency front? Because I heard the governor talk about inflation targeting, which to me would be a measure to contain money supply growth, which is important in maintaining current stability at the moment. But you would agree with me that inflation targeting is not a one-day job. It would need time to be achieved. What we have is money in the economy, and the momentum coming out of that money in the momentum cannot be dealt with in one day. As banks start to trade, it is going to be unavoidable for the banks to meet. It is not going to be possible for the banks to meet outstanding invoices, which in my view spill into billions of dollars against 451 million, which is available at Reserve Bank, of which the part of it is going to meet essentials as per retention schemes in place at the moment. So we would want a satisfactory lending strategy to the market to be given by Reserve Bank.
Thank you, Mr. Yan. And once again, let me start by Ginger Echo Group. Ask a very good question. What we are saying, Mr. Trump, in simple and fair terms, is that currently the parallel rate of exchange, which you know yourself, is between 3 and 4 US dollars. Agree? Right. We are now saying, should the parallel rate of exchange guide the country, or should you do it formal? That is that we need to do formalize. 2, the take-on balances from currently today, the take-on balances will be, if you bring today's $600 million times 3 rate, it means that all the RTGS balances will wipe off. The banks will only be left to hold the 3 Bs, the savings bonds. So they will come to us for borrowing. It will then increase the rate. That they know how to borrow money. And by so being out there for the whole people. So, the safeguards, no, you can go and try. The rest are just going to go down. And there is a limit which a bank can lend money because of their balance sheet. There is a limit which you can also borrow money from the market to go and purchase currency because they will hit you by interest. So, we think the soft lending will put it. On day 1, we are going to seed the banks to ensure that this is able to achieve what our dream is, to ensure that we stabilize the rate of exchange. I just want to give you the 36, but it's not all the $10 billion that is available to the market. The banks might end up borrowing from us, which they are going to do anyway. We know that. And once they start borrowing from us, we now come with what we call a bank rate. When the bank rate is established, that the banks also pass the value to what? The consumers. That's the position. Thank you.
Thank you very much, Calvin. I think that has been very clear.
Thank you, Honorable Governor. I'd just like to add a comment to support what he has been saying on 2 points. Firstly, relating to inflation. Inflation in Zimbabwe is currently entirely dictated by the parallel market rate. It has nothing to do with the monetary reality of the country. In fact, the RTGS balances have been quite stable for the last several months. And as you know, the Minister of Finance and the Ministry of Finance is putting every effort in place to keep control on government expenditure. So, the point is that inflation is being caused by parallel market rates of 4, 5, 6, 7, 8. Now the problem that is happening because people don't know how to price imports. And so they're putting any markup, any rate, and that causes inflation. Pharmaceuticals, somebody who's importing pharmaceuticals, it might be $1 worth of pharmaceuticals, he multiplies it by 6 and sells it to the pharmacies. That causes inflation. This system will stop that completely because you will have a transparent interbank rate on a daily basis, which will be the rate which will be used by the market and by importers to price their goods. And it is our opinion that it is likely to be in the range of under 3. So we are likely to have a fall in inflation rather than an increase in inflation. The second point I would just like to add to what the Governor has said about the exchange rate running away. This foreign exchange market. If you want to buy a Porsche or an aeroplane, you are not going to come onto this market. Okay, this is the market which is for essential users. And apart from that, to reassert what he said about RTGS, lots of reasons why the rate will not float away at all. Many safeguards are going to be put in place, and I'm sure you will be hearing more about these safeguards from the Reserve Bank in due course. Thank you.
Thank you, Professor Ashok, for elaborating on the points that needed, further explanation. And just to reassure that we, okay, and the gentleman at the back. Thank you. Thank you. All right.
My name is Privilege. Forgive me for my ignorance. Where does the bond note fit in this whole page?
Correct. Says. You don't have the question?
My name is Selection Amasa from Interfaith. But I have read anything about incentives for depositors.